today. Recent bank failures, including those at Silicon Valley Bank and Signature Bank, are textbook examples of executive incompetence, financial mismanagement, and incidentally, the brokenness in Washington. Both the Fed and the FDIC need to make meaningful cultural and operational changes to respond to problems faster and restore confidence in the system. I'm an original co-sponsor of the bipartisan bill, the Financial Regulators Transparency Act, alongside Senators Warren and Tillis and other members of this committee. This bill will ensure we can hold regulators accountable to the cultural and operational changes they've pledged to make. We'll discuss this more in Thursday's hearing. Today is about financial mismanagement by bank executives, which is where the lion's share of the blame should rest. Mr. Becker, thank you for being here. Page 6 of your testimony states that, quote, on the advice of Goldman Sachs, you decided to sell your AFS portfolio first. Did Silicon Valley Bank retain Goldman Sachs as a financial advisor or fiduciary?
Goldman Sachs was the investment bank that was running the transaction for us, so they were our advisor.
There's a news article today in the Financial Times where Goldman Sachs informed SVB in writing, quote, we would not act as their advisor on the sale, and SVB should not rely on any advice from the bank in this regard, but instead hire a third-party financial advisor, end quote. Is that an accurate letter that you received from Goldman Sachs?
Senator, I don't remember reading that document.
Mr. Chair, I'll just submit this for the record. This is an article in the Financial Times today, and Goldman Sachs provided this information to SVB in writing. So the way you phrased your testimony implies that Goldman Sachs advised you to sell the portfolio like a financial advisor would. But we see here there was a letter where they were not retained as a financial advisor or fiduciary. If they were, you would have a contract. So it seems like they were acting in a principal capacity, perhaps as a bidder for the assets. Did SVB have a financial advisor advising on this transaction in March of 2023?
Senator, the sole investment bank that we were working with at that time was Goldman Sachs.
Okay, so either Goldman Sachs did write a letter saying that they would not be your advisor on the sale, or they did. So what did Goldman Sachs advise you in this contract that we're not sure exists and that Goldman Sachs says does not exist?
Senator, the only thing I can do is give my memory of what happened. And again, I don't have access to the bank documents, but my memory is very clear. It was, as we were looking to do two things. One is raise equity, and the second one is to sell all or a portion of our AFS portfolio. Goldman Sachs was the investment bank we worked with on both. And as we were having the discussion with our board of directors, or specifically the special committee of the board that was really the ones working with the management team on this, the direct feedback that we received from Goldman Sachs is that to show the purpose for the fundraise, the capital raise, because otherwise our capital ratios and liquidity was strong, we would need to sell the securities first to show the loss and then to bring the capital on board later that day or the next few days.
And was Goldman Sachs your advisor on that sale?
On the sale of the securities?
That you're just describing, yes.
Goldman Sachs was the investment bank that we worked with on that.
Mr. Chair, it might be useful to try and get a hold of this letter because Goldman Sachs says that they informed SVB in writing that they would not be the advisor on this sale. Your testimony faults the interest rate environment for your failure, but I find it fascinating that other institutions, all of which were dealing with the same interest rate increases, seems to have hedged better than SVB. So why do you think other banks survived in the same environment where your bank failed?
Senator, as I tried to describe in my written testimony, I actually think the unrealized losses across the banking sector, just the securities, but also, and I think this is not as well discussed, the loan portfolio. So when banks have loans that are longer duration, those unrealized losses exist. I tried to highlight the fact that our loan portfolio is short duration and was variable rate, 90% of it. So when you look at the entire balance sheet and you look at duration and interest rate risk, I think you have to look at all the assets on a balance sheet. And so our loans would reprice every day, or when rates would increase. So we benefited from that as rates went up. And so the discussion around the securities portfolio is because it was really offsetting the variable interest rates we had in our loan portfolio.
Senator Brett.
Thank you so much. Thank you